99.5. New subject and same subject, but this dovetails off of what we've been talking about to the point that I would include it in the same subject. 99.5. Okay. What the hell is not, there's two revenue rulings that we're going to be talking about, maybe more, I think, but only two that I know of. We're going to be talking about 99.5 and 99.6. 99.5 is the concept of a single member LLC going to a multi-member LLC. (99-5). So Pete owns L1 and L1 owns land. Sam, who do you want to call in?
Nate.
Who?
Nate.
Nate. Is L1 a disregarded entity, assuming no check the box?
Yes.
Okay, and what's that mean?
Means it's a single member LLC.
And who owns the land for tax purposes?
Pete,
Okay. Who owns it legally?
the entity.
L1.
Yes.
Okay. So an LLC is a chameleon. Does everybody know what I mean by that? Brett, what do I mean by that?
It can be multiple things.
Okay, based on fact pattern. Okay, it can change its stripes based on its fact pattern. So if you have two-member LLC, how's that taxed? No check the box.
Partnership.
Partnership. Okay, so let's do this for a second. I own P. P owns, or I own L1, and L1 owns ground. You become an owner of L1. Is it a partnership?
Yes.
Okay. We don't like each other anymore. You kick me out, and you own L1. What is it?
Single member LLC.
And how's it taxed?
Sole proprietorship.
Disregarded.
Yeah.
Right? So it could be a sole proprietorship. So I started out with L1, which was disregarded. You owned it for a brief moment in time, or however we want to say it. And now we have two members. It's partnership, because by virtue of having two members. Then I exit, and now you have all the units. Now it is a single member LLC to you. So that in that way, it's a chameleon. Based on the fact pattern, this is going to dictate how the LLC is taxed. So what 99.5 says is, well, wait a minute. If we had Brett, we went from a single member LLC to multi-member LLC. 99.5 is addressing that fact pattern. So what 99.5 says is there's two ways this can happen. And I'm going to say land basis and fair market value is 10,000. Fair market value is 100,000. Equity 10,000, and there's no debt. So that's kind of a balance sheet of the single member LLC. What 99.5 says is Brett can enter the partnership one of two ways, and we're going to be 50-50. Okay, Brett and I are going to be 50-50 partners when the dust settles. Brett, what two transactions do you think are possible or might manifest to make you a partner in this partnership? How could you get LLC units?
I can bring cash to the table,
You can bring cash, that's one.
or I can buy part of your existing shares.
you can buy part of my existing shares. So let's stick with the bring cash to the table first. If you bring to the cash to the table, did anybody note the page with the steps, 704 steps?
Oh, I did.
Okay.
He's so proud of himself.
He was 100%, 100% proud. Okay. So what are our steps?
Determine the property that's contributed to the partnership.
Hold on, let's stop there. What property is being contributed to the partnership?
Cash.
Cash and
I don't remember.
what else?
Land.
Land. Is land really being contributed though? From a legal perspective?
No.
But for tax perspective,
Yes.
it is. We always, as tax people, have to understand when we enter into the land of fiction. And we are now entering into the land of fiction. Because who owns the land legally, Brett?
L1.
L1. But who owns it for tax purposes?
Pete.
Pete. So if we have this tax fiction that Pete owns the ground as a single member LLC, we would also have a tax fiction that Pete's contributing to it, contributing the land when it becomes a partnership. Okay? So what are the assets, Brett, or Noodles?
Cash and land.
Cash and land. What's the next step?
Determine the fair market value of property being contributed. The fair market value is generally agreed upon by the partners who contributed to the partnership.
Okay, how much is the ground worth?
100,000.
Which would infer Brett is contributing how much?
100,000.
Okay? So the ground is inferred to be worth 100,000 because he's bringing 100,000 in cash. So what do we do next?
Determine the tax basis of the property contributed to the partnership.
How much space is in the ground?
10 grand.
And what space is in cash?
100.
Okay? What's next?
Construct 704B, C, and inherent gain balance sheet.
Okay, my 704B. What do I got?
You have land of 10,000.
B. We're on B.
Oh.
You said B first for whatever reason.
You have
That's the way I wrote it, I'm sure.
you have cash and land both of 100,000.
Okay? And?
And then you have equity for P and B, each of 100,000.
Okay, what about my C?
C, the land is going to be 10,000, and P's equity is going to be 10,000,
Okay?
and then cash and Brett will both be 100,000.
Okay?
And then inherent gain, you'll have a $90,000 gain on the land and Pete equity.
Okay? Everybody's on board with that. Okay? That's maybe situation one. I mean, there's situation one and situation two in 99.5. So you have this tax fiction that Pete's transferring his ground to a newly formed partnership by virtue of Brett contributing $100,000 to the LLC in exchange for the LLC units, right? So now, what was the second option, Brett?
I buy your interest in.
So,
So
Shares.
let's label this for if whatever graphic purposes. This is scenario. Let's find out which scenario it is. I'm almost positive it's going to be one. What's situation one? B, who is not related to A. Oh, it's scenario two. We covered scenario two. B, who's not related to A, contributes $10,000 to the LLC in exchange for 50% of the ownership interest. The LLC uses all the contributed asset, contributed cash in the business. A and B continue to operate the business and LLC as co-owners. So this is situation number 2 under 99.5. Okay, what was the other one, Brett?
I buy your interest in.
You buy your
So-
interest. That's situation 1. So now if you buy my interest, and we're going to be 50-50, how much cash do you have to come with? Sam, how much cash do you have to come with?
You're going 50/50?
5 grand?
I didn't know.
Well, but let's think about this. How much? We got basis and fair market value. Basis is 10, fair market's 100. Equity is 100. If he's just going to buy straight up 50% of my ground, how much cash would he owe me? 50K. Okay? So you got to come with $50,000. So you're going to buy 50, you're going to pay me $50,000. And I'm going to give you units. Okay? Noodles, what did we say L1 was regarded or disregarded prior to his entry?
Disregarded.
Disregarded. Okay? And if that's true, when he pays me $50,000 for 50% of the units, what's that transaction? What did I sell him exactly? Brad?
Units,
Legally, but what did I sell him for tax?
land,
Land. So, Pete's going to have a gain-loss calc. Proceeds is how much, Brad?
50,
50K. Basis is how much, Brad?
50, or 5, sorry.
5. So Pete now has a gain of 45K. And what's the character of that gain, Brad?
It depends
On?
what the land was used for before.
Yep. So it could be
Inventory.
capital, it could be inventory, which is ordinary, it could be 1231. It's going to depend on how Pete held that ground in L1. Okay? So, step 1 is there's a gain-loss calc that needs to occur with respect to the percentage of the asset that was sold based on the percentage of units that were purchased. So in this case, Brett gave me $50,000 cash. The thing was worth 100, so 50% of the asset was sold by me. What did you buy, Brad? Or Brett?
I bought ownership interest.
Legally. But what did you buy for tax?
Land.
Land. So now what's your basis in your land?
50.
50. Okay, and this is all the world of land in the land of fiction. Because legally you bought units. Legally I sold units. From a tax perspective, I sold ground. From a tax perspective, you bought ground. Okay, so you have to get through that first hoop, or this first analysis, before we get to Noodles' procedure. What's the procedure, Noodles?
Determine the property that's contributed to the partnership.
What property is being contributed to the partnership?
Land,
By who?
both of you now.
Both of us now. What? Then what?
Then determine the fair market value of the property being contributed.
Okay, what's the fair market value of the ground that Pete's contributing?
50.
50. What's the fair value that Brett's contributing?
50.
What's the basis that Pete has in his ground?
5.
What's the basis that Brett has in his ground?
50.
Okay, then what's it say?
Then determine the tax basis,
Okay,
which,
we did.
yep. Then
Okay.
704B and 704C, an inherent gain balance sheet.
Okay, so what was contributed?
Land.
Land, I'm gonna call it land B and land
B.
P.
Okay.
Okay. What's fair value?
50,000 for each.
Okay. And equity?
50,000 for each. For B and P.
And 704C?
Yeah.
Land B?
Land B is 50, land P is 5, and equity is the same, like the 50 and 5.
Okay. Inherent gain? So 99.5 is a revenue procedure or revenue ruling that says you have a multi-member LLC, a single member LLC going to a multi-member. And but what are the two transactions that are possible for it to go from a single to a multi? And what were those two transactions, Brett?
Contribute cash
Contribute cash
or buy ownership
or
interest.
buy ownership. Okay, so in the contribute cash, and this is scenario 1, based on this, what we just did is scenario 1. Or situation 1, however we want to say it. In situation 1, before we get to the 704 procedures that we've outlined in the previous pages, we have to first do the gain-loss analysis for the person who's selling, because that's happening a minute before the formation of the partnership. Because tax fiction says Pete owns the ground, not the LLC. Tax fiction says Brett purchased the ground, not LLC interests. So that's a tax fiction that you have to understand exists before you get to your 704 procedure. And that 704 procedure would be, and the reason we have to do that, the first thing you have to do, Noodles, is what from your procedure?
What you're actually contributing.
Determine what you're actually contributing. So I have to break this apart, meaning Brett has to have a piece of ground, I have to have a piece of ground. How did Brett get that ground? He purchased that piece of ground. That means I sold the ground. That means I have a gain or loss on the sale of that ground. And now that reduces my basis because I sold 50% of it. My basis was reduced from 10 to 5 because I used 5 of my basis in my gain-loss calc. I have to do that piece before I can even say who has what asset to contribute to the partnership. Then once I get through that knothole, then I follow through with that 704. Who has what assets? What's the fair value of the asset? What's the basis of that asset? Use that information and construct my 704 BC balance sheet and come out with my inherent gain. Did I miss anything, Noodles?
Sounds pretty good.
Okay, so 704 is something that we confront all the time. A lot, I think. Yeah, Hoffman?
I would think so, yeah.
I mean,
Well, I would say at least 50% of our partnerships, probably. And I would say, if you're dealing with real estate, it's probably 75% plus of the time.
I think you're light, but
Yeah,
Yeah.
probably.
I mean, I would almost say, given some of the things you confront, it's closer to 100%. When you talk about deferred developer fees and because
Just land in general.
and land in general, you know, and scraping gain, whether you don't scrape gain, all sorts of things come into that.
In that scenario up there, Pete, in your infinite wisdom, if that land was inventory, is there a way to manipulate the character of the gain you'll recognize?
If it was inventory going in,
Mm-hmm.
not to my knowledge. I mean, if it was inventory in,
Meaning, so I set this up because we've done this. Change it to multi-member first with a related, your related party, and then sell your units.
Well, if it's inventory, that's 751 asset though.
Yeah. True.
So then you're saying.
But if you have other, land's a bad example. If it's an operating activity and you don't have much for depreciated assets,
You can manipulate the gain by creating an LLC or a partnership. That is true. But if it's ordinary in your hands and you have fair value assigned to it, it's kind of hard. Fair value assigned to the ordinary, 751 is going to capture,
most.
yeah, whatever that difference is. However, there's a form 8308.
Which is much more, in 2024, I think there's a lot more detail involved on that
I was
8308.
gonna say it's new. I
Yeah.
mean, it's not new, but the
You have to disclose all the assets on that form.
disclosures are new.
Which, again, going back to the basis schedules, going back to this BOI, going back to this foreign disclosure, going back to all these things. I mean, we're becoming a government reporting arm. You know, we're disclosing things that I don't think we should be required to disclose. Because a hot asset is defined as what? Okay, so let's back up. Because does everybody know what the 8308 is? Nope. 8308, back when I was in your shoes, was a form that's just you raised your hand and said, the sale of this interest might result in ordinary income. Then they revised that to say, the sale of an interest, we now have a reporting mechanism on the K1 that you're now required to disclose the amount of hot asset gain that you should push to the person. I think it's code AB. Is that right, Benny?
Yeah, I'm not sure where.
Like box 20 code AB or something stupid.
Oh, something like that.
That says, on the K1 itself, it says, your amount of hot assets for the sale of this interest is $100,000. That never existed. Then they took this form 8308. Okay, so a hot asset, let's stop there for a second. A hot asset is defined as cash basis AR, depreciation recapture, and appreciated inventory. Those were the categories, and that's what should be quantified in that box 20. Well, this 8308, I think, has overstepped its bounds. Because on the 8308, as it currently stands, if I understand correctly, is undercaptured 1250. I think there's 28% gain for collectibles. What else was added to it?
Have you seen it?
I haven't seen it.
I haven't seen it.
I just know it's out there.
talked to a couple of people about it.
Well, Campy's the one who said, didn't you say, and he said undercaptured 1250 is not a problem, and that shouldn't be taxed? And yeah, that's been the rule I've been dealing with my whole life. Does anybody see a bar I can type something in? Okay, here we go. Does it say 8308?
There's also that box on the bottom of the K1 that now says amount of 704C or 704B.
Yeah, that's been the last couple of years.
I think this would be a dismiss. I don't even know what that is. Gain from collectibles, gain from unrecaptured 1250. So not only do you have your hot assets in line 1, you're supposed to be disclosing, which, fair enough. That's always been the rule. Okay, so now we're playing by the rules. We should be disclosing it. We should have been more honest in previous years versus playing games. We should have, fine, fair enough. But this concept of collectibles as a 28% rate and undercaptured 1250, not fair enough. Those aren't hot assets. The rule under 741, and 741 is a provision that says the sale or exchange of a partnership interest is capital. In the same way, the sale or exchange GE stock is capital, unless there's 751 hot assets. And to the extent there's 751 hot assets, we're going to require you to recharacterize your gain to a portion that's ordinary to the extent there's hot assets. Well, that's line 1. That's the rule in the code. It never says, well, and if you have something embedded in there that's collectible that would be a 28%, you got to do that too. And it also doesn't say, if you have 25% tax rate on unrecaptured, you have to do that too. There's no technical hook out there that I know of that says that you have to look through your partnership interest to the assets on the balance sheet to capture the 28% rate gain or 28% rate associated with collectibles or the 25% rate associated with undercaptured 1250. There's nothing out there.
So, dumb question. Should there ever be anything on those lines?
I'm never going to put anything on those lines. I think that's an overreach. I don't know what, and I could be wrong. Because again, I go back to the rule is the gain's going to be capital. Well, so here's the potential. I'm going to play the part of the IRS for just 1 second. Okay, just for a second. I can see them making this argument. What is the character of gain associated with collectibles?
28
Not the rate. What's character?
capital.
Pretty sure it's capital. What's the character of undercaptured 1250?
Ordinary, kind of.
Nope, it's capital. So both those items can be offset by a capital loss. So they are, in fact, capital in nature. So would the IRS argue that 741 says that it's capital in nature, the sale of a partnership interest is capital in nature, but you have to recharacterize for 751 hot assets? Their subsequent argument could be, well, capital now can be bifurcated into 3 buckets. One is just capital, one is for collectibles, and one is for undercaptured 1250. Maybe, because they are capital in nature. But I've never read it that way at all, ever. And I think I would not populate that line, and sorry, I don't understand, because I'm an old guy, and the 8308 is a form that I just kind of always attach, never give much thought, and hot assets are this. Sorry. Whoops. I think this is an overreach.
8308.
But like at the top.
And the way that's,
A lot of times we, in the past, before that line was there, we'd either fill this out or not fill this out.
there's a penalty for not
Yeah. If
attaching
you
it.
fill this out, we would typically put any hot asset 751 items in the footnotes of the K1.
Yeah,
We'd use a long time ago, just fill it out and wait for somebody to ask, because we didn't calculate it till they asked.
Yes.
If it was outside of what a client we did not do the 1040 for.
okay, so, but here's the thing.
Nobody asked.
Well, but, or here's the issue. Because at the end of the day, Hoffman or buyer and seller on an asset purchase congruent or have the same interests, economic interests in how purchase price allocation is
No.
done. Why? Well, let's be buyer for a second. Where do you want to push purchase price?
Appreciable assets,
Shortest lived depreciable assets. Why?
because I get a deduction for those items.
You get
Ordinary deduction for those.
and quicker.
And quicker.
Okay. As seller, where do I want to put that?
Goodwill,
Goodwill. Why?
capital
Capital.
gain treatment.
And the seller still gets a write-off. It's over 15 years.
It's over 15 years guaranteed.
Okay, so you have this adversarial relationship in between buyer and seller, not adversarial that we want to take a gun and shoot each other, but adversarial that what's good for me isn't necessarily good for you, and it all comes down to a negotiation. Now, with respect to this hot assets piece, if somebody buys an interest in a partnership, is there some sort of election that can be made for step up in basis?
I've heard of one.
Noodles, what is it?
704, 754.
That was almost code Tourette's. I thought you were just going to start spitting out a bunch of sevens.
Just throwing out numbers.
301.
One landed.
Yeah, that's what I actually started to expect to see coming out of Nate over there was code Tourette's.
99.5. 610.
Okay, so 754. Okay, and the 754, which we're going to cover at some point in the middle of all this, steps up the basis of the assets. And the step up of the basis of the assets, is it based on the fair value of the underlying assets, or is it based on the tax basis of the underlying assets?
Fair value.
Fair value.
I would say yes.
Okay, so
He's
if
got my back.
No, not yes to fair value, yes to both.
Oh.
he'd say yes to both. Depends on which side of the equation you're on.
Yep.
Okay, so if you have a 754 step up associated with your PP&E, do you think that that'd be a hot asset with respect to the seller? Yes, so that's going to be yes. So to the extent we're taking a 754 step up on property, plant, and equipment, then the seller, we would be required to characterize, at least in my view, would be required to characterize on box 20, code AB, or whatever that is, that step up amount is a hot asset for gain recharacterization purposes. Because the buyer is getting the 754 write-off associated with those assets, which means fair value is higher, which means there was inherent gain that would have generated ordinary income, and that ordinary income should have been pushed to the seller. But the bottom of this form is, I believe, an overreach.
So that 8308 is a partnership form.
It is. When there's a sale or exchange of a partnership interest.
Do you need to fill that out if there's no hot assets?
My stance when I was closer to your age or Hoppin's age or whoever, in the end, because I believe that there's a penalty associated with not filling it out. And if there's a presence of hot assets and you didn't fill out the form, I think there's a penalty. You guys know what the penalty is?
No, but there's always the underlying thought out there that if you don't fill this out, it's considered not a return, not a filed return, and it leaves your statute open forever.
Is it adequate disclosure? Yeah, I'm with Pete on this.
I've never heard that one before in my life. I've heard of adequate disclosure with respect to gift tax returns.
I think there's been, I don't know that it's been, like, I've heard it in trainings saying that the IRS will try to argue that you have an open statute if you don't file, it's not considered a filed return if you don't fill out everything correctly.
We'd have a lot of exposure as a firm if that was the case.
I don't know that they've been able to stand on that, but it's been threatened as people not wanting to do certain things, and the scare tactic in trainings have been, it's not considered a filed return.
Okay. I've never.
I
heard
don't
that
know
before.
if that's, again, I've heard it in trainings.
Is
As
the
a scare
IRS putting on the training?
tactic. Sponsored.
Sponsored by your good friends at the IRS. I've never heard that before. I've heard that in the context of a gift tax return. There's an actual rule out there for a gift tax return. If you don't have adequate disclosure for the value that's been assigned to a not readily valued asset, I mean, you need an appraisal, that adequate disclosure is required to make statute run. That is true. That one I know. But I've never heard that extended into a 1040.
I think it was, that dipshit that came in a couple years ago that told us we had to take pictures of our home office and back
and
out
the treadmill?
back out the treadmill.
Well, in my house, that's a clothes hanger, but yes. Okay, so let's see.
Are mineral interests that have been
Why the
depleted?
fuck are you asking me about mineral interests?
I'm just here for commentary, people.
All right, I'll answer the question, but it's going to be led with, I don't know.
Well, and actually, after you get done with these trainings, I have a client that has this issue. So
A mineral interest issue?
there's a redemption of one of the partners, and they are taking mineral interests with them on their way out the door, and we have depleted the mineral interest.
What are the two answers in the world, Sam?
Yes, and I don't know.
I'm a sure as hell in the I don't know. Is the sale of a depleted mineral interest item a ordinary income item?
I don't know. I don't.
Immaterial.
think it is.
Immaterial?
Immaterial.
Inside, outside basis.
Inside outside basis.
Okay.
Don't worry, Doug.
So stupid question. My sense is everybody in the room kind of understood what that was. Is that fair? Leslie, did you understand what we just did? Kelsey? Alyssa? Sam? Brett?
Yep.
Brad? Noodles? Huntoff? I don't give a shit about the other two.
Wait, noodles. That's a new one.
Okay,
We'll tell you
just-
at lunch.
Okay. Okay, so that's 99.5. I don't think, do you guys want to do the examples more of 99.5, or are we good? Sam, you get to decide.
Do you need to waste time until like again?
No. I mean, okay, what Sam just said is, why wouldn't we do this? That's what she just said, I think is what just happened. Okay? So Sam, since you made the choice to do it, you get to call on whoever gets to do it. I want to hear the audible groan from whoever you choose.
This is hard.
What do you mean? You can choose yourself.
Well, you know what? Yeah.
Okay, let's do it.
Jim owns
Oh, are
ground.
you choosing somebody else?
No,
Okay, let's go.
I'm gonna get it wrong, but I'll do it. Jim owns ground with a cost basis of 200 grand and a fair market value of $1 million in AB LLC. Sam has $1 million of cash. Jim and Sam believe that they could partner together to develop the land. Sam contributes $1 million to AB LLC in exchange for AB units. What are the tax consequences to Jim? He He gets taxed on the gain on the sale of the land.
So what did Sam cross purchase the units, or did he contribute? Okay, so the contribution, the question you have to ask yourself, in order for Jim to have a current income tax consequence as a result of the introduction of the member comes in one of two categories. One, did he receive any cash? Jim received cash?
Oh, no, not Jim himself.
Jim did not receive cash. So if Jim did not receive cash, that turns off one. Then the second is what we talked about in the formation class. Is this an investment partnership? Was there a transfer of debt in excess that would result in excess of basis? It would be those other items which come through the formation analysis to get that done. So does Jim have a current income tax consequence by virtue of Sam contributing money? He does not. Okay, what are the tax consequences to Sam?
No.
Nothing. Okay, so let's broaden the scope of the question. When the contribution to cash goes into the partnership, what is the tax fiction that's occurring, Sam?
Buying units.
Jim owns what? Let's start back at the basics.
Jim owns land.
Well, for tax purposes, correct?
Yes.
Okay, but let's start with legal reality. What does Jim own legally, not from an income tax perspective?
The business.
He owns AB LLC or something?
Yeah.
Okay. So how is that different than what we have with Pete and Brad? So we got Jim that owns AB LLC. Okay, that's legally, correct? That's what that first line says, does it not?
Yeah.
Okay, and AB LLC has what?
So AB LLC owns the ground,
It does legally,
but not tax fiction.
but not tax fiction.
Okay.
Okay. So AB LLC owns ground of $1 million with a fair value of $1 million and $200,000 of basis. So, what does Jim own from a legal or from a tax fiction perspective? The land. So, Sam contributes $1 million to AB LLC for 50% of the interest. Okay? So, there were two situations. What were those two situations, Kelsey?
Contribute property or buy units.
And which one are we in?
Contribute property.
Okay? So, if it was a sale where somebody got cash, there was a, let me take back up. Noodles, do we have a procedure that we have to follow?
Yeah.
The formation?
Mm-hmm.
Yes. But when there's a purchase or there's cash going across, there's something that has to happen first. So when cash goes across, there's an additional analysis that has to be done, and that's the analysis of sale or exchange. Okay? If there is no cash going across, we're under our normal procedures of what we have. So, from a tax fiction perspective, Sam, what does Sam own? Not tax fiction. From a tax fiction perspective, what does Jim own? Land. And Sam actually owns what?
Money.
Cash. So Sam's going to transfer his cash to who?
AB,
AB. And what's he getting?
land, / units.
So he's getting units. AB owns land. He's going to have units in AB. Okay? So what's the procedure? The 704 procedure.
The first step, you have to figure out what was contributed into the partnership.
What was contributed, Sam, from a tax fiction and reality?
Money and the units.
Land.
Land.
Are going into AB. Okay? So AB is receiving land fictionally, and cash. What's step 2, Noodles?
Determine the fair market value of the property contributed.
What's fair market value of the land?
A million.
A million. And what's fair value of the cash?
A million.
Okay. What's step 2?
Well, that was step 2.
Or excuse me, 3.
Step 3, we determine the tax basis.
What's tax basis in the land?
200,000.
Tax basis in the cash?
A million.
A million. And what comes next?
Then we make our 704B, 704C, and inherent gain balance sheets.
You lumped a lot together there, didn't you? What's 704B balance sheet, Sam?
Cash of a million. Land of a million.
Okay.
And then Jim and Sam both have a million.
Okay. 704C.
Cash of a million. Land of 200,000. And then that.
Then that. And then inherent gain.
0, 800,000, and then 800.
Okay. So, let's go back to this. Jim owns what legally, Sam?
Legally, he owns 80.
What does he own for tax fiction purposes?
The land.
The land. Okay, by virtue, and a single member LLC is a disregarded entity or is it a regarded entity? Single members, if tax fiction he owns it, it's disregarded. If you have multi-member, it's regarded, correct? So how did it go from being disregarded to regarded? That's where the tax fiction comes in. Disregarded means who owns the land when Jim owns the LLC. Who owns the land from a tax perspective?
Jim.
Jim. But legally, he truly owns AB. So let me ask this question. If Jim owned the ground, let's not worry about AB. If Jim owned the ground, who owns the ground? If you go down to the where people title land, who owns the ground? Jim. If Jim and Sam call the law firm and say, we want to form a new LLC. We're going to form a new LLC. Jim, I'm going to transfer my ground to the LLC. Sam says, I'm going to transfer my cash. Do you have to go down to the Register of Deeds and retitle the ground to the LLC? Is there an actual transfer? Yes, because you're forming a partnership. Did Sam actually transfer his cash to a bank account at the LLC? Yes. That is easy to recognize. Okay, I think where we ended was trying to wrap our head around tax fiction versus reality. And I was going down the path, if Jim owned the ground specifically, or Jim owned the ground and it was actually registered to him, no LLC existed, and Sam came with $1 million, and if they called a law firm and said, hey, we want to form an LLC whereby Jim is going to transfer his ground and Sam is going to transfer his cash, all the items are moving. There's an action that actually is taking place, correct? So everybody can see those actions are taking place. So now you have to be able to take those actions and pretend they occur on some level when tax fiction is required. And tax fiction is a single member LLC is it regarded, Kelsey, or is it disregarded?
Disregarded.
Disregarded and absent a check the box, which means tax fiction, who owns the ground?
Jim.
So if Jim owns it from a tax fiction, today and it's in the partnership tomorrow, what is the tax fiction that occurred?
We contributed property to form a partnership.
Okay, Jim transferred the ground from a tax perspective into the partnership. Okay, and what were the two situations under 99.5?
You could contribute property or buy interest.
You can contribute property or buy interest. And if you contribute property, do we start with Nate's procedures right out of the chute, or do we have
Yes.
to do something else?
Nate's.
Okay, we start with those procedures. If we have a purchase of an LLC interest, do we have something else that has to occur?
Yes, you have to calculate the gain on Jim's, is it like a sale? Is that,
Yep.
okay.
And then I have acquisition cost on the other side.
Yeah.
Okay, so when we say Jim owns ground with cost basis of 200,000 and fair market value of $1 million in ABC LLC, Sam has $1 million of cash. Jim and Sam believe that they could put together, they could partner to develop the land, and Sam contributes $1 million to ABC. Are we in the situation where we have the gain and loss calc, or are we in Nate's procedures?
Nate's procedures.
In Nate's procedures. And Nate's procedures say what?
First, we have to figure out what was actually contributed.
Okay, and are we dealing in legal reality, or are we dealing in tax fiction?
Tax
Tax
fiction.
fiction. Tax fiction, because what does Jim own from a fiction perspective?
From a fiction perspective, he owns the land.
He owns the land.
Yes.
Sam actually owns the cash, right?
Oh, yeah.
So if Sam contributes the cash to the entity, Sam is physically contributing the cash, correct? But the land doesn't have to move because ABC LLC already owns the ground, correct?
Yeah.
But we have to execute on the fiction. And in a friend of mine's words, you have to live the fiction. And the fiction says Jim owns what, Noodles?
The land.
And after Sam contributes the cash, what's Jim own?
Shares in the entity.
A partnership interest.
Yeah.
Okay. So at that point, we have to do our procedure, which is what assets were contributed. So what assets were contributed?
Cash and land.
Cash and land. What's fair value?
Cash is cash. Land's fair value is $1 million.
Basis.
Cash is $1 million, and basis in the ground is 200.
Okay. Equity section. Or now we have the 704B, 704C, inherent gain balance sheet. We got all that, I think. Okay, so what's the tax consequence to Jim? Well, the tax consequence to Jim is he contributed his ground in exchange for partnership interest, and he had to go through the normal 704 procedures. That's the tax consequence to Jim. The same for Sam. You have to do the balance sheets. Sam, who you want to call in?
Brett.
What's this say, Brett?
Jim owns ground with a cost basis of 200,000 and a fair market value of $1 million in AB LLC. Sam has $1 million in cash. Jim and Sam believe that they could partner together to develop the land. Sam pays Jim 500,000 in cash in exchange for 50% of the AB units owned by Jim.
Okay. So the tax. Let's start with the tax. What's the tax fiction? What does Jim own?
Jim owns the land.
Okay. And Sam genuinely owns cash. And how much cash is in play?
500,000.
Okay.
Or he has $1 million, but he's gonna pay Jim 500.
Okay. So now we go back to, I said earlier that if you have this cross purchase, what's the tax fiction of that cross purchase? What is Sam buying?
Sam is buying land that Jim owns.
Okay. What's proceeds to Jim?
500,000.
What space is being utilized?
100,000.
How did you arrive at 100,000?
Half of the basis.
Half the basis.
Based on
So
fair market value is $1 million and he's getting 500, so half of it.
Yep. And the gain.
400.
So now we're still in the land of fiction.
Yep.
What does Sam own?
Sam now owns land.
With what basis?
500.
Okay. So now we go into Nate's procedures. What's step one, Nate?
Determine what was contributed.
What was contributed, Brett?
They both contribute land.
They both contribute land. What's next, Noodles?
Then you have to figure out the fair market value.
What's fair market value of the land being contributed or deemed to
Million.
be contributed?
$1 million.
For who?
Total.
Total. And so what's each person contributing?
500.
500 each. What's next?
Then you figure out your tax basis.
What's Jim's tax basis?
Jim's is 100.
Okay, which was, he started at 200. 100 was utilized to the sale or exchange, correct?
Correct.
And then what's Sam's basis?
500.
Because he
what bought
acquired it
for.
from Jim. Okay. What's next?
Next, you find you make your 704B, C, and inherent gain balance sheets.
Okay, what's my 704B balance sheet, Brett?
500 for everyone.
500 for the ground A, ground B, and the equity.
Yep.
Okay, so, or Jim ground, Sam ground, and equity. So what about the 704C?
704C would be 500 for Sam for both land and his equity, and then 100 for Jim's land and equity.
Okay. Does that make sense to everybody on some level? How often do I see this?
So you probably see the first one more than the second one.
Maybe. Maybe
So I
not.
guess, like, why wouldn't you do the first one and then just distribute out the cash so you don't have a gain to report?
We're going to cover that. It's called 707. Disguised sale rules. I mean, people have tried that. It doesn't work. Okay? But, so let's talk about this for a second. Because I use this all the time, and some of you, I think, might be familiar with this. Okay? Let me ask a stupid question. I think we covered this in 2. Maybe. If I have S1 that's owned by A. S1 is an S Corp. Can anybody tell me what this transaction is where A contributes S1 in exchange for S2 stock, where at the end S2 owns 100% of S1, A owns 100% of S2, and there's a Q sub election made. Anybody know what that transaction is?
F reorg.
It's an F reorg. How often do we see an F reorg? A lot. I mean, I wouldn't call this M&A 101, but this is done all the time. So let me ask a stupid question. Let's go back to S1. Who can tell me the characteristics or the rules that say that allow a corporation to be classified as an S corporation? What? And it's a not definition. Anybody?
Are you talking about like the 100 shareholders
100
stuff?
shareholders. Can't have more than 100 shareholders.
U.S. citizens.
U.S. citizen.
Yeah. Qualifying trusts
Could
or
be a green card. I think you can have a green card. I can't remember. Go ahead.
qualifying trust or estates,
Qualifying trust or estate
not a partnership.
has to be an individual. Okay. And two classes you can only have one class of stock. Everybody remember that? Okay, so let's say, Mr. Huntoff, let's say that there might be some beef concern somewhere. I'm not sure exactly how all this really worked, honestly.
Okay.
Okay. And the beef concern is an S corporation. And that beef concern has a knock at the door from a venture capital company that says, we're willing to give you, Mr. Huntoff, $10 million. And what we want is 40% of the company. I'm just making stuff up. Okay. And venture capital is a partnership. And you said the venture capital as a partnership would not be an acceptable shareholder. And if that's not an acceptable shareholder, what would that do to my S election?
Blows it up.
Blows up. And now how am I taxed?
C corp.
Okay. So John says, I want to keep flow through status. You are an inappropriate shareholder. And embedded in S1 is lots of operations. Okay. Stuff that is hard to transfer. And you can't own 40% of me or you're going to bust the S election. So what's an F reorg? Can you articulate what an F reorg is for anybody that doesn't know?
Not confidently.
A mere change of form. That's all it is. So an F reorg is S2 owning 100% of S1 with a Q sub. Is Q sub a disregarded entity or a regarded entity?
Disregarded.
Disregarded. And does anybody remember that the tax fiction, because we talked about tax fiction in 2 that said all the assets and liabilities that are still owned by S1 are deemed to liquidate up into S2, and that S1, by virtue of that liquidation, becomes disregarded. Does that seem familiar at all? Okay. So if somebody knocks on the door and says, I want 40% of this company, an F reorg with another step is a possible solution to allowing them in without busting my S election. So what we can do is take S1, contribute S1 to S2, whereby A owns 100% of S2, S2 owns 100% of S1, and a Q sub election is made. And let's do this for a second. S1 does this on December 31st of a given year. And S1 let's say on November 30th. S1 earns $100,000 a month. Hey, math girl. What's $100,000 a month? What's that net income?
1.2 million.
1.2 million. Okay. So prior to S1 being contributed to S2, and this being the ownership structure, how much was earned through the year? And it happened on November 30th, or 11 months.
1.1.
1.1. How much is yet to be earned?
100,000.
100,000. So while A owned S1, 1.1 revenue was earned. While A owned S2 and S2 owned S1, $100,000 was earned. Who files a tax return and how much is reported on that tax return? Anybody got a guess?
S2.
S2 what? File its tax return?
Yes.
And how much is reported on S2's return?
1.2.
1.2. An F reorg is a mere change of form. A owning S1 is exactly equivalent to A owning S2, which owns 100% with S1 with a Q sub election. It's a mere change of form. And there was that form, oh, actually, I can't remember. What's Q sub? 8869. There's the Form 8869, question 14 that says, is this a F reorg pursuant to Rev Proc or Revenue Ruling 2008-18, which says this is a mere change of form, which puts the IRS on notice they shouldn't expect a return from S1. They should expect a return from S2 with an entirely new EIN number and 1.2 million of income for the full year. So why am I bringing all this up? Because this seems not pertinent at all to what we're talking about until it is. Okay? So once we get into the structure, Brett, do you know what formless conversion means? What I mean by that?
You don't have to file 2553. Oh, that's S corp. 8832.
Okay. Benny, what's formless conversion?
It's where you convert your tax status without actually.
Your tax status. What's tax status mean? Hoffman?
In Pete's words, it's the attorneys wave the magic wand
They do. They wave a magic wand.
and turn the an S corp into an LLC,
They turn not an S corp, just an Inc.
an Inc into an LLC.
Okay, so A owns S2. And let me ask you a question. Is S1 and Inc. Q sub disregarded, Brett?
Yes.
Okay. Is a single member LLC disregarded, Brett?
Yes.
Okay, so when we wave the magic wand and go to the Secretary of State, it's truly a formless conversion form. You go to the Secretary of State and say, I no longer want S1 to be an Inc. on your books and records. I want to change it to LLC status. And that conversion from Inc. to LLC status is the same DNA. S1 has the same DNA, has the same legal history, it has the same EIN, it has everything bad associated with it, but it's no longer Inc. on the books and records of the state. It's now LLC. So what we've done is we started at a point where S1, somebody wanted 40% of S1. And if they bought stock, A's stock, we would have busted S1's S election. And if we busted S1's S election, is that a good thing? A is not interested in that. So the solution is A transfers the stock to S2 in exchange for S2 stock, whereby A owns 100% of S2, S2 owns 100% of S1, Q sub election, which makes S1 disregarded for tax purposes. Then we go to the Secretary of State. We no longer want to be an Inc. We want to be an LLC. And in comes 99.5. What does S2 own, Sam? Which is now what kind of entity? LLC. And when we look at Revenue 99.5, 99.5 is addressing 99.5 is addressing a single member LLC can go into multi-member LLC. So now we have a single member LLC going to multi-member LLC. And now here comes the VC. The VC transfers to S2 10 million. S2 transfers 40% S1 units. Does that look like anything what we've been doing? Is that situation 1 or situation 2?
One.
Situation 1. Situation 1 says what, Brett?
You purchase ownership interest?
Purchase LLC interest. I use this all the time. Okay, so can you see the utility of not wanting to bust the S election? Can you see the utility of VC wants to buy 40% of this? And then structuring into an F reorg to get this to disregarded status. And once I get this into disregarded status, I can change it from Inc. status to LLC status. And by virtue of converting it to LLC status, now I have a currency called LLC units that I can use to transact on. And now I can sell 40% of my LLC units for $10 million. And that means I've sold, pursuant to this RevProc, so let's do it. Let's say S1's balance sheet is cash of 100, AR of 200, land, let's see, 700, equity, 1,000, right? And we'll change this to, instead of 10 million to 10,000. Okay? If Brad, what's my fair value? I'm selling 40%.
So it would be
No, let's make it 50%.
20,000.
It'd be 20,000 of fair value. Correct? What liabilities do I have?
None.
0. So I have 20,000 of total. So this now comes up to 20,000. Correct? So I'm gonna have 100 of cash, 200, and just to make life easy, I'm gonna say 700 of land, and goodwill happens to be 19,000. Everybody good with that math? Is everybody with me? Okay. So we're now going to sell 50% of this. So let's go back to the simple land and see if we can work our way through this. Okay. Brad, what's the fact pattern here?
Are we doing the same one we did last time?
Yep. Jim owns.
Yep. Jim owns ground with the cost basis of 200,000 and a fair market value of $1 million. In AB LLC, Sam has $1 million of cash. Jim and Sam believe they could partner together to develop the land. Sam pays Jim 500,000 cash in exchange for 50% of the AB units owned by Jim.
Okay. So what is the tax fiction here? What does Jim own?
Jim owns land.
Okay. So stupid question. Let's correlate to what we have here. Who owns what? A owns S2, S2 owns S1. Who owns what? How do we diagnose this?
S2 owns all the stuff, the cash, the AR, and the land.
S2 owns the cash, AR, and land, and has self-created goodwill. S2 owns that, correct? So what happens up here next? What's the step that we have to follow before
Oh, gain loss calc.
gain loss calc? Okay. So how much of the land did Jim sell as a percentage? Half. and you did a gain loss calc on half. Okay, so, and this might be better if we just go ahead and put this into a spreadsheet, because, so we have cash, what did I say?
500,000.
No, up here.
Oh. 100,000.
I have AR,
200.
200,
Land of 700. Which totals 1,000, and then equity of 1,000.
okay? Equity is
1,000.
Oops. Is 1,000, correct?
Yep.
Okay, and we're saying that our, what the hell is it? This is tax basis. Okay. Cash is cash, so we're saying, well, our equity section we're saying is how much?
20,000.
20,000. Where is it? Okay, which means, and I said AR was what it was, land was what it was, and this is 19, correct?
Yep.
Okay, so if we sold everything, we would have a gain of 19, correct?
Mm-hmm.
How much are we selling?
Half.
Okay, so we're selling, you're saying 50%, correct, Kelsey?
Yep. Yes.
0.5. So, I'm going to take this up one. Tax basis, fair market value, gain. Okay. Times 4 times F4 okay. And then, so let's talk about what just happened. 50% of the stuff just got sold, did it not? So going back to just the simple piece of Jim sold his ground, we took 50% of one asset and compared it to 50% of his basis and did the gain loss calc, correct? In this case, we know we have a universe of assets, which in this case happens to be cash, AR, land, and goodwill, that we know that we have to buy at 50%. Okay, so we now have this gain, all right? Now, what happens? Okay, so now we're through the sale of the ground, are we not? Everybody's correlating to what's happening with this transaction to the simple land. Okay, then what happens, Brad?
Then we have to make the 704 B and C capital accounts.
Okay, we have to identify the assets being contributed, right? Isn't that step one, Noodles?
That is.
Okay, what's second? Let's talk about what those are, and then let's go do it.
Second is determine fair market value.
Okay,
Next is determine tax basis.
yep,
and then we make our 704 BC and inherent gain balances.
So in the case of the cross purchase, the deemed cross purchase of the land, Sam's basis in the ground was what, Brad?
Two hundred or
Was
Was-
500.
oh, yeah,
And
And
Jim's was how much?
the 100.
100, because we utilized half of the $200,000 basis in that gain loss calc, correct?
Mhm.
Okay, so let's now correlate that back to here. Okay? This, how much basis does the VC have in cash? How much does the VC have in AR, and how much does the VC have in land, and how much does the VC have in goodwill? Basis. Kelsey?
Is it the 50, 100, and 350?
And?
0 for goodwill.
No, the venture capital actually bought 50%. They paid $10,000. So let's flip this across because I did you a disservice. So the VC actually paid, did they not pay $10,000? Right here?
Yes.
Okay, so they bought a 50% interest of the assets. The same way Sam bought 50% of the land. So since the VC bought 50%, what's the basis they have in the cash, AR, land, and goodwill?
50, 100, 350, and then the 9,500 in goodwill.
Okay, and S2's gain is how much?
The 9,500.
The 9,500. The same way Jim's gain was 400. Okay, so we've identified the assets being contributed by the VC. What assets are being contributed by S2, or deemed to be being contributed?
The cash, the AR, and the land.
And
Goodwill.
yes. So let's go back to Jim. What was Jim's basis and what he contributed?
100,000.
And how did we arrive at that 100,000?
Because we calculated his gain, which used half of the 200,000 of his original basis.
Okay. So how would we arrive at the basis in the S2 assets that are remaining behind?
Half of what's being contributed, because the other half we use to calculate the gain.
So are you saying, Kelsey, it's this times, I'm gonna put this right here, plus 1 minus this. Okay, and we're gonna play with this for a second. Are you saying it's this basis
Mm-hmm.
times the amount of basis not used?
Yes.
Okay, F4 okay. So I have $50 of basis in cash, $50 of or 100 of basis in AR, land 350, and I'm no basis in the goodwill. So going back to the very, very simple example, Jim had a piece of ground. He sold 50% of it for 500,000. We utilized half the basis in its gain loss calc, which resulted in Jim's case of $400,000 gain, but in this case, it's 9,500. Jim's base or Sam's basis, or in this case the VC's basis. Sam's basis was 500,000 because that's what he paid. VC's basis is 50 in cash, because bought 50%. 100 in AR, 350, and 9,500 because they actually paid for 50% of the assets. So now we've identified the assets, right, Noodles?
Yep.
Now what?
After identifying the assets,
Yeah.
then you find your fair market value,
Okay.
which, yeah, then you find your tax basis. Then we make our 704 B and C
Okay.
balance
So
sheets.
let's stick with that. So what's the fair market value? Okay. Fair market value. What's fair market value of the VC's assets?
10,000.
What's fair market value of S2's assets?
10,000.
What's the tax basis of the VC's assets?
500.
What is it, Kelsey?
10,000
Why?
because they bought half of the assets.
The same way Sam bought half the ground.
Yeah.
Okay. So what's the tax basis in S2's assets?
500.
500. Okay. If we talk about this, we sell one asset. All the moving pieces are a little bit easier to spot. Okay. So now what's the next procedure? Noodles.
Now we make our 704 B and C balance sheets.
Okay, 704 B. And then I'm going to come over here and grab this. Okay, so if I was going to let's do this just for fun. Okay? If I was going to say I was going to color code any columns over here to populate R, what columns would I color code, Noodles? Melissa?
So fair market value, so like the 50, 100, 350.
What columns? Is it H, I, J, K, L, M, N, O, P? Which columns?
Oh,
O?
Yeah.
Okay. And then which columns, which other column? Because this is S2,
okay.
S2, and this is VC. Okay, which column? K.
Okay.
Okay. All right. So if we go, now we're going to draw from those, right? How's everybody feel about that? Now, if we have 704C, Melissa, who you want to call in?
Leslie.
Leslie, if I was going to color code this column to green, which columns over here would I draw from to pull over?
Would be tax basis, would be J and N.
I think it's J and N. How you feel about that, Melissa?
Wouldn't you need to add in the 9,500? Since that's basis for VC.
Okay. So And I probably need to say VC and S2, right? Because that's something that we should have been doing. And this VC should have pulled from this column. And this should have pulled from this column, correct? So VC equity, you're saying, Alyssa, is pulling from this column, correct?
Yeah.
And you're saying this is pulling from this column, correct?
Yeah.
And now we have inherent gain, do we not?
Yes.
That went the wrong way on me. Hold on. All right, I did do it. Okay. You fucking moron. Okay, so this is something we do all the time. And why do we do this? Let's go back to the top. You have a party interested in buying S1. John, is this actually kind of what happened?
Yeah, it is kind of what happened.
Okay,
It is.
I have no idea.
Yeah.
Right? This is 100% speculation on my part.
Yep.
So you have A owning S1. You have VC that wants to buy S1. VC is going to do what to S1 if they buy it, Sam? Below the S selection? We don't want that, do we, Sam? We don't want that at all. So we say, okay, we know a way around this because you want 40% of it. We're going to have S1 contribute to S2. S2 owns 100% of S1. S1 does a Q sub election. The mere action of contribution of S1 to S2 with Q sub election, that's good F reorg. On 8869, question 14, is that the question number, Benny? Just say yes. Yeah, and it says this is an F reorg pursuant to 2018. Sam, is this disregarded or regarded once Q sub is made? Disregarded. Since disregarded, we go to the Secretary of State. We convert the Inc. to LLC status. Inc. to LLC status. Now S2 owns a single member LLC. By virtue of going through this process, gets us into 99.5. Because now, when VC comes in and buys 40% of the interest, and we're going to change this, buys 40% of the interest, then they're buying LLC interest. That's situation one under 99.5, whereby VC is coming in and they're deemed to buy 40% of the assets. They're deemed to buy 40% of the assets, and we'll come back, which is, that's what's going on here. They paid $10,000, correct? The $10,000 has to be allocated among the assets, 50 to cash, 100 to AR, 350 to land, plug to goodwill. Just like with Sam and Jim, Jim still retained half of his basis, which was 50, 100, and 350. Okay? And then, pursuant to the procedure, we've identified that the VC has fair value assets and basis, because they bought half of them, of 50, 100, 350, 9,500, just like Sam had it. We know, just like Jim, half the basis, which was coming from a column over there, still is with S2. Then we say, okay, well, our 704B is the fair value and the fair value for 20 million or 20,000. And then 704C, we have to reflect on, or we have to capture the purchase portion the same way we did with Sam. Sam's number was 500,000. In this case, this is 10,000. So the VC and Sam are the same. Jim kept half his stuff, so he retained basis. So Jim had 100,000 of basis. In this case, there's 500. You take both those, put it in 704B and 704C balance sheet, and that's how you use an F reorg in 99.5 to get into a state, a currency status that doesn't bust your S selection. This happens more than zero. And actually, do you remember this? Does this feel like maybe like franchise special lanes?
Yeah.
Yeah.
Yeah. That kind of sucked.
So you've seen this,
Yeah.
okay? And that particular client, okay, this is baffling to me. Do you remember what it was capitalized? The value that was capitalized in 2018?
Mhm.
So somebody put $1,000, $1,000 into a company, 800 by one party and 200 by another party. And when it sold in 2022, how much did it sell for? Hold on. How much do you think it sold for in 2022?
Say the biggest number you've ever seen.
Do you know the number?
You told me this story
100 times?
recently.
Oh.
Is this from last week?
Yeah.
Yeah,
What's the number?
it's really big.
It's really big.
145 million.
You're the first person that's ever guessed over, and not by much. 140.
Thought I heard you tell a story once.
Okay. But $1,000 in 2018 converted into 140 million. And that's the return that you did. And it had this in there.
Is that complete? Complete nutrition?
No, but it's one of the former owners of that.
How did they manage to like they put $1,000 in and then they sold it for that much? How did it just went up?
I
that
have
much?
no idea. And Leslie, quite frankly, if I knew, I wouldn't be here. I mean, because my goal is to what?
Retire.
Retire, yes. And if I had the ability to have $140 million, do you think I'd be here? No, I would not. Okay, so let's change our number. So
You've changed, Pete.
do what?
You've changed.
Used to do it for the love of the game.
Yeah, uh-huh. Okay, so what happens if we change this to 0.4? This automatically populates now to show your tax basis consumed at 400, original tax basis with 1,000. That leaves 600 of the basis remaining, which populates all this. And let's see, let's pull that back up. This portion of this analysis, where we have rolled and sold, is exactly that. I have to deal with rolled and sold all the time, because in this case, in the spreadsheet case, this is the sold portion, the 40%, and the sold portion has a gain-loss calc associated with it. And the gain-loss calc, since there's a gain-loss calc, the purchasing member has basis equal to fair market value. Basis and fair market value are the same. Then the sold piece of it is, well, what basis was not consumed and rolled into the next venture so I can get to my tax basis equity of 600. I got a bust in there somewhere. I don't know why that is. I got a problem there. Oh. Whatever. I got a formula there. I have 600 of tax basis coming over. I changed the overall value. So I have to know what is rolled versus sold. The purchased / sold piece is going to populate the purchasing partner side. Fair market value and basis are the same. Then I've got my rolled piece, which is the proportional amount of basis that was not utilized pursuant to the sale, and it rolls up into an entity. How often do I use this? I use this all the time. I mean, you saw it in standard, and you would have seen it in franchise fast lanes. You see the utilization of that a lot, and knowing that you can preserve your S election by executing F reorg, getting it to single member LLC status. Single member LLC status opens the door to revenue ruling 99-5. And Brett, what's 99-5 address?
Single member LLC to multi-member LLC.
And there's the two situations. Correct?
Yeah.
Which one is contribution and one is purchase.
Yes.
And so when I think Brad said earlier, well, the one that's probably most common is the contribution. I think you said that, right?
Yes.
Okay. In my view, most likely the most common is going to be rolled versus sold and purchased because of all these transactions. And that may just be by virtue of the stuff I see. That doesn't mean that my universe of data points is the world's best.
So if they sell now for like 100,000,
Do what?
like in this example, if they sold for 100,000 subsequently, S2 would have the first 11.4 of gain. Is that correct?
Yeah. 100%. So 704 is pervasive everywhere. An S corp, did I say an S corp has to have memory? Why does an S corp have to have memory? Sam?
Per share per day.
Per share per day. There's none of this tacking or tracking of inherent gain to a particular partner. And a partnership, though, on the other hand, has to have a memory. I don't even want to talk about what just went through my head.